I'm looking forward to giving the presentation today. I have given similar presentations in the past, so you may have seen something like this before. I do have some new information in today's presentation, which I think everybody will find interesting. What we're going to be talking about is two real simple swing trading strategies, and while they're simple, they are effective. And I'm also going to be talking about how I look to improve them, all right, or how I look to improve strategies like them. Before I get into it, let me give you a minute to look at our risk disclosure statement. If you've traded for more than a few days, you've probably had a loss at some point. So trading's risky, and the other thing to note here is that a lot of the information I'm going to be sharing is back-tested data, and history doesn't repeat itself exactly, but I've learned an awful lot over the years by running back tests and studying the market. And I think it's a great tool, and it's something that's helped me tremendously in my own trading. That said, nothing's perfect, and you need to trade at your own risk. Well, Renee did a nice job of introducing me. In fact, I think she hit on basically all these points, so I won't spend a whole lot of time here. But like she said, I've been trading for about 20 years now. I have a small firm called Hanna Capital Management. My trading was initially kind of a combination of swing trading and day trade. It was more day trading, and then I utilized some intermediate term styles. And over the years, I began doing more and more quant research, and I moved more towards swing trading as my primary vehicle. I also created methods for overnight trading, and those are utilized at InvestiQuant, formerly at Overnight Edges, which is now part of InvestiQuant. InvestiQuant was founded in 2014. I've been around there since the start. If you have any questions, there's my email. I'll give it at the end as well. So don't worry if you forget, but it's rob@investquant.com. Pretty simple. All right, two simple but effective swing trading strategies, and here's the key: how to improve them. All right, this is our first swing trading strategy. I'm not telling you the rules yet, but I will tell you the rules. But this is a picture of what it looks like. When I talk about swing trading, I'm looking for short-term market swings. So generally the trades will last somewhere between a couple days and a week or week and a half a lot of the time. Sometimes you can be in them a little bit longer, but this is generally what we look for when we're looking to swing trade. We see market dips here, and then we sell on the bounce. We get another dip here, and we're selling into a bounce. A dip here, we sell into the bounce. A dip here, and what you see is we're in and out and in and out. We're taking advantage of all these little market swings, right? And most of these trades are all. You can see this was a few years ago for SPY. But this system did remarkably well, and there are losers along the way also. So here you had the dip, and it sold into the bounce, but it wasn't necessarily a bounce that's going to take you back above the open. So there are winners, there are losers, like with any system. But this overall looks pretty good. Like, how can we figure out where to get in here, and how can we figure out the best time to get out? These are some pretty nicely timed entries and exits that you see along the way. Right? So let's take a look at the rules. I won't keep it a secret too long. This is something I call my 5-day low, 5-day high strategy. The entry rule: we're going to buy a 5-day closing low. So we're going to look at today's closing price in relation to the previous 4 days. And if today's closing price is the lowest in the group of 5, meaning today, and then the previous 4, we're going to look to enter long tomorrow morning. And for purposes of this particular strategy, the way I set it up, I said we're going to use a limit order equal to today's closing price. Okay, so if we get an unfilled gap up, that's not going to be taken. The reason for that is sometimes large gaps up are difficult to buy into. It doesn't mean there's no edge in doing it, but from a psychological standpoint, traders often don't like to be buying into large gaps up. So I just made this as simple and easy to follow as possible. And we're using a limit order equal to today's closing price for this particular system. Exit rule. Again, we're going to be selling the 5-day closing high. So we're looking at today's price in relation to the previous 4 days. If today's closing price is the highest in the group of 5 days, we're exiting at the close. So this is pretty simple to set up in the morning. And if I'm trading a system that's looking to get out at a high or above a moving average or something like that at the close today, I'll know that number that I need as soon as the market opens. And so I'll put in limit on close orders is what I'll do. So in this case, if, well, I'll look at a real time of SPY, 1, 2, 3, 4, 5. The highest close the last 5 days was on August 31st, and the close was at 290.31. So if I wanted to make sure I got out on a 5-day high close, I would put in a limit on close order right now for 290.31, and then if SPY closed there or higher, I'd be out at the end of the day. And if it didn't, I would the order would expire, and I'd look to set it up again tomorrow at whatever the 5-day high was. All right, which tomorrow would be the same level because that's only 3 days back. All right, let's look at it. I'll go through this quick because I think you guys are getting it here. But point 2 is where we see our first 5-day closing low. We can't see the bar before this, but this was a 5-day closing low. We look to enter the next morning at the open. That's what happens here. So we get in at point 3, and then we're looking to sell a 5-day high. And in that case, we're counting back 1, 2, 3, 4, 5. That's where the exit is signaled, okay? So today and the previous 4. Let me know if you have any questions throughout, and I will try and make sure that I can see all the questions in this box. Although it may take me a minute to spot it. All right, now that you know the rules, you can see what we're doing here. 5-day low, enter at the open, out at the exit. 5-day low here, enter at that limit. Right, that one popped up. We had to wait for it to pull back. Enter at the 5-day close. This was the loser, right? 5-day low. We enter the next morning, and the market sells off further. But we wait until we get a 5-day closing high, which is right here, and we exit there. Okay, so a lot of winners. Did have one pretty good sized loser there. All right, you understand the rules. Let's look at the results of running this back several years. All right, and I ran it back to 2007 because that's as far back as we have a lot of our complete swing edges data, and that at least gets us back before the previous bear market as well. So if we look at the stats here, I'll note a couple of things. One, yeah, it's profitable. It actually made money on almost 71% of the trades. So that's pretty interesting. The profit factor, that's something I'll be talking about. I'll be talking about throughout. So let me explain what profit factor is right now. It's basically your gross profits, in this case 186,000, divided by your gross losses, 125,000, right? So 186 divided by 125 is 1.5. It's a way that system traders generally look to compare systems. Okay, so if you have two systems and they both made $61,000, one did it with 186,000 in gains and 125,000 losses for a profit factor 1.5. That's viewed more favorably than one that had 900,000 in gains and 840,000 in losses, right? You'd rather get to this 60,000 number without having to do that much more trading and worry about that many more losses. Your chance of drawdowns are substantially reduced when you have higher profit factors. Okay, the average trade here, a little over 1/3 of 1%. This is 100,000 per trade, so 333 would be 1/3 of a percent. All right, and I'll also note the total days that we were invested, and that's basically just looking at the average bar in the total trades and multiplying that by the total trades. So we were in a trade for 1,079 total days. Okay. I always like to look at profit curves as well, and here's the profit curve. Profit curve tells us the story better than numbers do a lot of the time. So this is how it looked throughout the trades. 2018 struggled a little bit, mostly thanks to the February explosion. Interestingly, so this is new information for this presentation here. I decided to run this same little system back across all of the S&P 500 constituents. So a lot of people have asked me, well, is this fine-tuned for SPY? And the answer is no, it's just a basic idea where you're looking to buy oversold and then sell when it gets overbought on a short-term basis. So, buy low, sell high. And what would have happened if I ran it on all of the S&P 500 individual stocks? And running it over this long time period would have produced an awful lot of trades. And this doesn't assume any kind of portfolio return. This assumes you basically have unlimited capital, right? And you're taking every trade that triggers with an equal amount. So in this case, I said $10,000 every trade. Probably should have done 100,000 to match. But your average gain, your average trade would have been about a 0.5% gain, which is actually a little better than the SPY one. Your average bars held would have been about 6. So if we look at here, about 6 bars and about 1/3%. So using individual stocks, you get a little bit more juice than trading the S&P 500 directly. Now, are there issues with this system? Sure. It's a tough system in my mind to actually implement because it's hard to have confidence that today's 5-day low is a great entry point, right? A lot of times when you're hitting a 5-day low, it feels pretty bad. And today the market's making a new 5-day low for the second day in a row, maybe the third day in a row. So things feel pretty bad today, right? So it's often tough buying into these. So we'll talk a little later about what can give you more confidence in the entries, and that's an important thing. All right, before I talk about improving the system, oh, I'm getting some questions here. So this is mean reversion. Yeah, Ankit is asking, this is a mean reversion strategy. Somewhat. Mean reversion, we would look for a reversion to the mean. So it's similar in the idea as buying pullbacks, but this is actually exiting at a 5-day high rather than a 5-day moving average, for instance. If I said we're going to buy 5-day lows and exit the 5-day moving average, that's really mean reversion because you're looking for a reversion to the middle of the range, okay? Can it be done with call options? Possibly. There's a number of ways to trade options, and you could use, one popular way to do this would be to use like out of the money, I'm sorry, deep in the money options, and then you got a high delta, And if the stock or the ETF bounces, then you'll be able to take advantage of it. But with options, because there's time decay and there's premium in there, and there's other factors other than just the price of the security, you could be right about the direction and still lose money on an option trade. Of course, you can be wrong about the direction and make money in an option trade if you set up the option trade in a different way. So could use 5-day exponential moving average for a filter on a daily chart. You could use it as an exit signal, maybe. As a filter, it's not going to help you because we're buying at a 5-day low, so you'll always be below the moving average. I'll come back to is the underlying trend a factor? Define the trend, of course. Yes, so you could use a longer term moving average if you wanted. You wanted to say, oh, we want to be above the 50-day moving average or above the 200-day moving average to take these trades. That could be a valuable filter. Another filter you could use is a market filter, and that's one I'm going to be going to be looking at. Okay. Chuck, I don't do credit spreads myself, so I'm not sure if it would be an effective strategy for trading those. It might be too short term. Spreads on options are another thing you got to keep in mind too, and liquidity. A lot of times, liquidity isn't as strong. You know, with SPY, you got a good liquidity. But if you're trading anything other than SPY, a lot of times you don't have as much liquidity, especially if you're trading like mid-cap 400 stocks or something like that, trying to trade options with them. All right, so let's look at this simple seasonal strategy, and then I'll be happy to come back and answer any questions. So this is going to look to take advantage of turn of the month. Generally, towards the end of the month, the market has done better than other times of the month. So this is looking to buy the first trading day. I'm sorry. This is looking at the calendar and identifying the first trading day after the 24th. So if Monday was the 24th, we were talking about today would be Tuesday, we're going to buy tomorrow's open. That'd be the 26th. All right. First trading day after the 24th might not be the 25th. If the 24th falls on a Saturday, right, then it'd be the 25th. 26th would be the Monday. We'd be looking to buy the 27th. So first trading day after the 24th, we're going to buy SPY tomorrow at the open. And we're going to hold that until the close of the first trading day of the next month. All right. So we get to 31 or 30 or 28 or whatever it is. For the end of the month, we're waiting till the following day. It's the first of the new month. We're holding through the first, right? Or the second or the third if there's a weekend on the first. So first trading day, a new month, selling at the close. Got it? Pretty simple. This is how it would have done over basically the same period of time for SPY. So would have been profitable about 60% of the time. Profit factor 1.3 here. So you got 30% more in gains than losses. Total net profit 30,000. Average trade is about 0.2%. Okay, not great, not terrible. Decent profit curve, right? So you can see it's working its way higher over time. This big dip right there is thanks to the end of January, beginning of February, and we've bounced back a little bit since then over the last few months. Okay. So that is your simple seasonal strategy. There's a lot of seasonal strategies, and I've done a fair amount of work with seasonality, and I talk about it in much of my writing in the Navigator. I talk about it some with that's a newsletter. I'll talk about that later that I write for InvestQuant. And quantifiable edges, there's also quite a bit of work there that's seasonal. But I found seasonality to be a helpful tool, and if we can identify times where we can, where the market is generally favorable, that's a nice thing. And turn of the month is one of those times where you generally have the wind to your back. All right, so we've got two strategies here. One is the 5-day low, 5-day high strategy. The other one's their simple turn of the month strategy. Let's look at how we can possibly improve them. I'm going to talk about three concepts here, and these three concepts are the foundation of what we have at InvestQuant. We call our swing edges. All right, and swing edges is really comprised of 9 different short-term systems broken into 3 different concepts. One is acceleration, the other is momentum, and the other is seasonality. I'm jumping ahead. Acceleration is the first, and it basically looks at how fast is the market moving and from where. So in this case, we get a sharp move down coming out of a generally sideways consolidation, right? This same sharp move down coming out of a consolidation means something different than if it was coming after a long uptrend. And it also means something different than it was coming after a long downtrend. So acceleration measures the move previous to the current one and the current one, and how fast, how strong is that move up or down. Okay, so that's what we're looking for our acceleration stats. Momentum. Momentum measures how persistent has a move been over the last few days and weeks, how strong is a move, and where is it, again, trading in relation to the long-term trend. So this is a persistent move higher. So momentum and persistency really are kind of go hand in hand. And so we want to know, are we moving higher, and have we been doing so for a long time? Are we moving lower and we've been doing so for a long time? So it's really more of, it's not looking at the strength of the move, but more the persistency of the move. And then the third concept, we already talked about it, one seasonality system, but we measure seasonality a number of different ways at InvestQuant, and our seasonality systems provide 1, 3, and 5-day projections. So the guides, what we call our guides there, show historical odds of the symbols, and we have a couple hundred symbols about. I think it's somewhere around 150 stocks and another 58 ETFs that we track, and then there's 6 or 7 different futures contracts as well. And we show the historical odds of the market moving up or down over the next few days. And there's 3 momentum, 3 acceleration, 3 seasonality systems for a total 9 systems. And what I do is I'll look at the average of all of them. So there's so this is clear. There's a 1-day acceleration system, a 1-day momentum, and a 1-day seasonality. There's also a 3-day acceleration, 3-day momentum, 3-day seasonality. And they don't look at the exact same indicators. They look at slightly different stuff, but they are along the same lines of thinking. Okay. And what they do is they say, all right, where is the market now compared to similar market conditions over the last 10 years on a rolling basis? And then it produces odds. It says, all right, well, in similar situations, we've been up 3 days later, 60% of the time, and the profit factor has been 1.2 or 1.4 or whatever it is. We validated these systems back to 1971 to see how effective they would have been, and that's for momentum and seasonality. We were able to go back that far. We were able to go back to the late 90s for acceleration because we needed some additional intraday data that wasn't available all the way back into the 70s. The object of this is to identify when there is a clear short-term directional bias. for the market being measured. So what happens if we combine the 5-day low, 5-day high timing strategy with the IQ swing edges data? That's what I was talking about earlier, is a market filter. So let's take the same rules and let's say, all right, I want to see some good looking odds based on what swing edges data is showing for SPY. So here we say SPY closes a 5-day low, just like the 5-day low high system. But in addition to that, I want the swing edges guys to show a win rate of at least 55% and a profit factor of at least 1.3. And 55 and 1.3 are levels I've used for years, going back to 2012 or so with overnight edges. They're not magic numbers, but they're pretty solid as far as suggesting a good edge. And I want to say, if that is set up, if we've got this filter on as well as the 5-day closing low, we're buying tomorrow at the limit price, we're going to sell at the 5-day high, or the morning after the swing edges guides no longer meet our criteria. Okay, so in this case, what we see is we've got fewer trades, 150 versus I think it was 182. We've got shorter time frame trades. We've got just about the same amount of profits, and the average trade is making more. So that's generally what you want in a filter. If you're going to add a filter to your system, fewer trades, fewer days exposed to the market, similar profits, and smaller losses too. And I'll show a stats table a little later on. Here's the profit curve, which has been pretty much a nice steady move higher. The January, February time frame did hurt it a little bit, but it's got a nice little bounce here. Okay. This is a metric comparison. So the number of trades is down by 18%. Yeah, I'm trying to, I got some of the things in my way here. Oops. All right, days invested is about half, which is a big improvement, right? You're only in the market half the time as with doing the 5-day high, 5-day low. So it gives you less exposure. You can be trading other things. You can just be sitting aside and not putting your money at risk. You can be in treasuries. You can be in some other system you trade. All right, total profits, very close, almost the same, even only in the market about half the time. Your average size loss is down 36%. It's 36% improvement. Your max drawdown, 34% improvement. Average trade up 20%. So, like we said before, fewer trades, fewer days exposed to the market, similar profits, smaller losses, all good things. Run across all the S&P 500 stocks. This I showed earlier, right? About 0.5% per trade across the individual stocks. If I used the same swing edges filter and said, all right, if we got to buy, we're only buying when it says go, and if it no longer says go, if we don't have the win rate and profit factor necessary, we're getting out. This is what the stats were. So less trades, profits were almost the same, just about 0.5%, but look at this. Now, instead of holding for 6 days on average, you're in for a little over 3. Big improvement there. All right. So that's pretty impressive. That's why you look for market filters. And it can be something like a 200-day or a 50-day moving average. It can be something like swing edges data. Let's also look at combining a seasonal strategy with swing edges data. In this case, I'm being not as strict because I want to get in most of the end of months. And I'm pretty much just saying here, let's only not take these if we're showing bearish numbers, right? Or really not bullish. So I want a win rate of at least 50% and a profit factor. Instead of 1.3, I said 1.1. All right, and this other than that, the setup's the same. Buying the first day after the 24th, selling the close the first day of the trading month. I also said today's not the last day of the month, because buying tomorrow at the open would be buying the first day of the month at the open and selling it at the close, and that's not a swing trade anymore, it's a day trade. So I eliminated that as well. We end up with basically the same number of trades. We're gonna have more profits here, which is interesting. So I'll get to the comparison in a minute. Here's the curve. Again, pretty steady move higher. You know, bumps along the way, but not bad. Same number of trades with and without swing edges. Days invested, 20% or 18% less days invested. Profits are up 31%. So if you just avoid the times that the swing edges data was saying, looks like, you know, could potentially be bearish over the next few days, stepping out of the market during those times allows you to make substantially more money. Average trade is up, intraday drawdown is better. All right, I'm going to show just a few recent studies from the Swing Navigator, and then I'll go back and talk about the two systems some more, and answer any questions you might have about them. This one is looking at the, I did this a little while back and looked at the bullish odds broken down by market position, because market position can be important. This is something we can talk about a little bit more, even with regards to this system. But I'll often see sometimes I'll see bullish numbers and the market's already overbought, and I think, well, even though seasonality looks good, even though momentum or acceleration or whatever it is looking good overall, have the gains already been had here? And this looks at, all right, swing edges data is strong. We got the 55 and 1.3, looking to buy tomorrow, but the S&P is already at a 10-day high. And as you can see, this is not a curve that I find terribly appealing. You would have been basically break even after 59 trades. So the lesson here is, let's not get too excited when SPY is overbought. Generally, I want to see some kind of a pullback. I don't buy into overbought conditions most of the time. This is looking at, well, what if it's not overbought? So anytime it closes less than a 10-day high, and we got the swing edges data looking good. Well, the swing edges data has done us pretty well, right? So profit factor 1.9, average trade, a little over 30%, almost 0.4%, right? Right, 65 or 64.5% of the time. So that looks pretty good. It's a much better looking curve than the last one. And what if the odds look good and it were oversold? Well, this is the best of all, right? Now you're closing in on a 1% gain per trade. You're right about 75% of the time, profit factor of 3. So this is really kind of the sweet spot. All right, so you can take these kinds of things into account with a number of systems. You know, where is the market? Is it overbought or oversold short term? How does that impact reward risk? And do I have something else that's confirming? And that's what the swing edges data gives me, is just that confirmation. It's, all right, we're at a 5-day low, we're at a 10-day low, whatever it is. Are there things saying that this is a good place to try and look for a bounce? And so that's why I like to use market filters like the data. I do other seasonal edges from time to time. Like I said, I do a lot of work with different edges. Fed days I have found to be really valuable over the years. A Fed day, as I define it, is just a day where the Fed ends a scheduled meeting. They're all 2 days nowadays. They used to have 1 and 2 day meetings. But 8 times a year they'll get together, they'll have a policy meeting, And then at the end of the policy meeting, normally at 2 o'clock, sometimes around noon, most time around 2 o'clock, they will announce any changes, right? And they'll provide a statement to the public. And those changes will be related to, if there's going to be an interest rate change, or if there's going to be a change in quantitative easing or quantitative tightening. They will say that. And what I found is that Fed days over the long term have had a bullish bias, a strong bullish bias, and we can see it here. This goes back all the way to 1982, and it's been a steady move higher on Fed days when the market has been at has not been at a 20-day high. So we're not already overbought. Okay. When the market has been overbought, you're at a 20-day high, and you got a Fed day. There's been no edge. So, Fed days, you can have your conspiracy theories. Are they propping it up? Are they trying to make themselves look good? What's the deal? But it also could be part of the job, right? If the market's worried, if things are bad, if the economy's bad, it's part of the Fed's job to kind of talk us down a little, talk us off the ledge, right? So they'll say something nice and the market will move higher. But when things get a little too hot, then the Fed will look to calm the markets down a little. Irrational exuberance is the term that Alan Greenspan used to use, right? So if you're already at a high, the Fed doesn't need to talk the market up any higher, and they're probably not gonna. So that's what we see here, is that you're at a 20-day high already. The Fed is not going to provide you a whole lot of help. Reward risk isn't there like it would be in the previous slide. Oops, that we saw here. Okay. So looking to buy when the market's oversold or when a security is oversold and exit when it becomes overbought can be an effective approach to swing trading. The 5-day low, 5-day high is incredibly simple, and simple can be effective. And I've seen this with most of, I've seen it with all my systems, really. If I've got more than a few rules, chances are the system's not going to hold up quite as well as the back test shows. But if you can have a system that's got just a couple of simple rules, then there's a much better chance that it's going to continue to act that way in the future. Doesn't mean the market's not going to change. Doesn't mean the whole environment's not going to change on you, or market dynamics will change in some way. That'll happen, and you'll need to identify that. Not all, some systems might work for 5 years, some might work for 50 years, some might work for less than that. But overbought, oversold is something that has worked for a long, long time, and it's an effective approach to swing trading. Seasonality can provide a substantial edge. We saw a couple of examples of that. One is the turn of the month. Another is Fed days. Hey, if the market's not overbought and you're heading into a Fed day, you might be able to take advantage of that, jumping in front of it, especially if it's oversold going into a Fed day. So you get a 5-day low going into a Fed day, and you got end of month coming up. That's a pretty good setup most of the time. All right, you're not gonna make money every time, but you should make money more often than you lose money. Simple edges can be magnified when combined with other tools. And that's something that was really one of the goals when I was designing the swing edges, was let's combine these things. Let's combine seasonality, momentum, acceleration. Those are 3 things that I found strong edges with before. What if we average them all together? What's it going to tell us? And combined, they're more powerful than individually. So you can use something like the swing edges data, or you can use your own filters, whether it's a long-term trend filter, whether it's any it could be a volatility filter, it could be a a VIX filter, whatever you want. Let's see, Elaine's saying it appears seasonality is most, Aaron's asking which of the two strategies would you go with and why? I don't trade either of those strategies as is. If you're looking at 5-day low, 5-day high, in conjunction with other information, I trade those concepts. So swing edges is looking strong and we're at a low, yes, I'll be looking to get in. So that's a strategy I would trade. If I've got seasonality on my side, then I get even more excited about it. It appears seasonality is most effective. I don't know, from Elaine is saying that. I think they're both effective. I think the most effective is when you get a combination. Oversold going into a strong seasonal period is a setup I love. Let me just get to the end and I'll answer the questions. I want to just show the special offer we got going on for swing edges right now. Here's the coupon code. You can go to the website and it's basically $150 off. So you can get the first month for free if you sign up for a monthly plan, which is typically $149 a month, or if you sign up for a yearly plan, it's $150 off that. So you'd be charged $800 instead of $950. Even if you take the yearly, we have a 30-day money-back guarantee. So if you decided you didn't like it within the first 30 days, you just get your money back without any issues. Okay, so if you think you could learn something, if the style of trading you think it might be a match for you, I'd encourage you to give it a try. And if you like it, great, you can benefit from it. A lot of people have. But if it doesn't fit your style of trading, or if situation changes or whatever it is in the next 30 days, just shoot us a note, let us know, and you're off the hook. You can also get a free trial at Swing Trading Trial. Okay. And again, email me at rob@investquant.com if you have any questions. Stops. Do you place your stop at the previous candle bar's low? Oh, wait a minute. How do you hedge your overnight position with options? I don't. You can. I find that kind of hedging to be expensive most of the time. If I'm taking leveraged positions, then yeah, you probably want to do some options hedging. But most of the time, I don't hedge with options. Stops. You place your stop at the previous bar's candle low. These systems don't use stops. Most of the systems I trade, swing trading systems, I don't use stops. You can. When I look at stops, I prefer time stops over like a percent stop or something like that. But a lot of times you're already buying the low, so there isn't a low below there that you're looking to get in or out of. Have you looked at 10-day low high, and if so, any different? I've looked at, yeah, you can. 10-day lows are great. You may not want to wait for it to get all the way back to the 10-day high. So you could use maybe a 10-day moving average or something like that for the exit. But it would probably still work with a 10-day high. You'd probably want to put a trend filter on there though, right? So 10-day low high should be effective if you're in an uptrend. Can you do the same with SSO instead of SPY? Yes. It's all the same thing. In fact, what I generally do is I'll tune my system to SPY. I'll take SPY as signals, but I'll often trade SSO or UPRO or something like that. You ever heard about the strategy in the 10-day rule? How does it work relative to the 5-day you just presented? It's all the same concept, Tom. So it'll, you know, whether you're looking to get in oversold and get out when it bounces. And you want to have some type of confirmation to give you confidence to be able to get in when it's oversold. And that's what I look to swing edges for.